When global stock markets tumble and headlines warn of steep losses, many wonder, when do we buy the bottom? But the reality is, this downturn may still have a way to go. Recently, we've seen a frenzy. Investors rushing to sell, some fearing they've lost too much or sold at a loss. Remember, these reactions are often driven by emotion and panic. So, when is an asset truly cheap? Typically, it's when the market goes eerily quiet. As it becomes widespread and even non-investors take notice, prices are not just loathed, they're being given away to the few who are ready. This is when the true great transfer of wealth happens. During deep downturns, wealth moves quietly to those prepared to act. Hi everyone, welcome to Stewardship Finance Academy. We are a channel to build confident investors. Last year, Warren Buffett reduced his U.S. stock holdings, choosing to keep large amounts of cash even as markets were rallying and optimism was high. Many mocked him, believing he was out of touch. Yet as markets later fell due to tariffs and trade conflicts, those same investors who bought at the top felt the losses while Buffett avoided the worst of the downturn. This pattern highlights a bigger lesson. Market trends are shaped by forces beyond politics or individual leaders. Tariffs are just one example of tools that move markets. While some blame political risk, it's clear other deeper factors may be at play. Here's the bigger picture. In the past, the U.S. used higher interest rates to attract global capital. Now tariffs serve a similar purpose, aiming to draw capital back into the country, just by different means. As global markets weaken and asset prices drop, investors with cash can gradually buy undervalued assets. While rate hikes attract capital directly, tariffs can depress other markets, making foreign assets cheaper for U.S. investors. We may be entering the next phase of this cycle. To avoid becoming collateral damage or to take advantage of these shifts, consider subscribing to this channel for ongoing analysis and tips. And if you find these insights useful, remember to like and save the video for future reference. Let's look at what happened after the U.S. imposed tariffs. The stock market dropped sharply. Global markets losing an estimated $6.6 trillion in just 2 days. It's most focused on the losses, but few asked, where did the money actually go? In markets, every trade has a winner and a loser. Those who bought high lost value, while investors who sold early or shorted the market profited. Data shows that everyday investors and foreigners held most of the affected stocks, meaning they bore much of the loss, while sophisticated investors likely benefited. During the sell-off, President Trump tweeted, "It was the best time to buy stocks." Then soon announced a 90-day suspension of tariffs, prompting a quick rebound. This shows how a single policy statement can dramatically shift market direction. What's the most urgent issue for the U.S. government right now? The Treasury is running low on cash, raising the risk of a government shutdown. At the same time, demand for U.S. Treasury bonds has dropped since 2021, with fewer investors willing to lend money to the government. How might the government respond to this funding shortfall? One possibility is leveraging market sentiment by allowing a sharp market drop in, potentially anticipating it with short positions, then signaling a rebound through policy. Authorities could access market liquidity quickly. Timed well, this could extract capital without lasting harm. But if mishandled, confidence suffers and markets struggle to recover. President Trump once referred to an individual making $2.5 billion in a single day's market swing, highlighting how some benefit enormously during volatility.
This is Charles Schwab. It's not just a company, it's actually an individual. And he made $2.5 billion today, and he made $900 million. Because, he's in financials. I've always been fine.
This raises the question, are such swings being used as tools to transfer wealth to well-positioned investors, or even to government channels? The broader strategy might be to trigger a sell-off, then channel some of the freed capital into treasuries. After the tariff suspension, bond markets did rally briefly, but instability remained. Bonds opened higher and closed lower on heavy volume, suggesting smaller investors held the risk as bigger players exited. Why does this happen? When treasury auction demand is weak, big Wall Street firms often step in to buy. But once new investors arrive, these institutions may sell their holdings, building up cash to invest again at better prices. China and Japan, the largest holders of U.S. debt, also signaled treasury sales, seen by many as an economic countermeasure. As a result, efforts to shift capital from stocks into bonds didn't fully succeed. In short, the temporary tariff suspension aimed to ease the government's cash crunch and support treasury prices. But this likely isn't the end. Many view this as just the first move, testing the market's reaction. The strategy behind tariffs is similar to rate hikes. Disrupt global markets, then buy assets at distressed prices. The difference now is that tariffs aren't a response to crisis, they might be the cause. When U.S. interest rates rise, global capital flows into the U.S. for better returns, weakening other countries' markets and currencies. U.S. investors can then use their stronger dollars to buy undervalued foreign assets, extracting value from the global economy. Now tariffs serve as a more direct way to achieve this effect. For example, imagine the U.S. puts a $4 tariff on Vietnamese goods previously sold for $10. You have two options. Option 1. Raise your price to $14 to cover the tariff. This likely reduces demand, resulting in fewer sales, business losses, layoffs, and eventually, broader economic slowdown. As dollar inflows shrink, your currency and assets lose value. Option 2. Keep the price at $10 and absorb the tariff. Your profits disappear, leading to potential business closures and job losses. The outcome is similar: a weaker economy, currency, and asset valuations. Some countries try to offset tariffs by devaluing their currency. For example, if hit with a 40% tariff, a country might devalue its currency by 40% to stay competitive. This makes its exports cheaper. It also means its assets are less expensive for foreign buyers, like when the yen drops. It's making Japanese goods and assets more attractive to outsiders. Regardless of the response, the outcome is similar. It becomes harder for the country to earn US dollars. This leads to a weaker economy, falling currency, and discounted assets, allowing dollar holders to buy distressed assets worldwide. That's why tariffs impact not just the US, but global markets as well. Why would the US take this approach given the domestic risks? Because globally, the strongest economy often benefits most. While Americans may face higher prices, inflation, job losses, and market volatility, these effects are felt worldwide. After the 2008 crisis, US investors benefited by buying global assets at deep discounts, helping the US recover faster than others. If the US experiences only a mild recession, while other economies suffer deeper downturns, global capital tends to flow back into the US as a safe haven. While many argue Trump's tariffs are intended to bring jobs back or revive US manufacturing, the reality is more nuanced. The US has long leveraged its financial dominance to print dollars and buy global resources easily. Given this history, it's unlikely that Americans will suddenly shift en masse back to farming or factory work. Historically, tariffs are often a tool for wealth transfer. Though they seem to tax foreign nations, their true effects are far-reaching, functioning as an indirect tax on ordinary people everywhere. Whether you're an investor or a wage earner, you may face devalued assets, inflation, unemployment, and weaker currencies pressures that ultimately facilitate a transfer of wealth to those holding financial power. If you missed the chance to exit investments at their peak or didn't build up cash reserves, you still have options. Staying informed and prepared is essential. That's why I encourage you to check out our free stock investment masterclass, linked in the description. By joining, you'll gain valuable insights and strategies, all at no cost. Just subscribe to access these benefits. Don't miss this limited time opportunity. Key takeaway: tariffs are more than just economic levers. They're also bargaining chips for the US in negotiations. The message: cooperate to avoid tariffs, or risk economic instability and devalued assets sold off to opportunistic investors. Notably, major players like Warren Buffett, Bill Gates, and Mark Zuckerberg are reportedly holding large cash reserves waiting to buy assets at attractive prices. This latest round of tariffs is testing countries' responses. Surprisingly, many have pushed back not by complying, but by selling us debt, which led to falling bond prices and a weaker dollar. Rather than pouring money into the US, global capital is now flowing out. What does this mean? Many countries are choosing to endure financial turbulence rather than submit, marking a significant shift in the global economic landscape. With stocks, the dollar, and bonds all under pressure in the US, stabilizing one area often just shifts strain elsewhere. Even the Federal Reserve seems hesitant to intervene too aggressively, reflecting the uncertainty of this new era. What if stocks, bonds, and the dollar all fall at once? The US government could be forced to take drastic measures, potentially triggering a global financial crisis and an economic reset, one where the burden often shifts to other countries. Why have US stocks dropped so quickly? Leverage explains much of it. For example, if you buy a $100 stock that rises to $200, you might borrow against it to buy more shares. If the market plunges due to tariffs or other shocks, banks issue margin calls. If investors can't pay, stocks are liquidated, driving prices even lower. This domino effect leads to panic selling, not just of US stocks, but of other assets like European equities, oil, or cryptocurrencies, as investors scramble to raise cash. This drains liquidity from markets, causing a crunch and further price drops, a vicious cycle that can spiral out of control. The solution? Central banks often step in, injecting funds and stabilizing markets. Still, the timing and effectiveness of this intervention are uncertain, and the wider consequences of such crises are hard to predict. The Federal Reserve's main tool for stabilizing markets is its ability to expand its balance sheet and inject liquidity. The Fed generally has two options. The first is to cautiously print money while keeping interest rates high. This might prevent steep market declines and trigger a modest rebound, but any recovery could be weak or short-lived. More likely, however, is that the Fed waits until a crisis worsens before acting aggressively, as it did in 2008 and 2020 by printing large sums and offering near-zero interest loans to major institutions. This influx of capital enables well-positioned investors to buy up undervalued assets worldwide. Such measures serve both the Fed's stakeholders and the government. By stabilizing the U.S. faster than other economies, America retains its safe haven status and attracts foreign investment once markets settle. For institutional investors, these conditions offer a major opportunity. During global sell-offs, they can borrow cheaply to acquire discounted assets, further consolidating U.S. control over domestic and global resources. Lower rates also help ease debt burdens. This dynamic may explain why investors like Warren Buffett have trimmed bank stock holdings, anticipating that banks could suffer in a crisis due to loan defaults and liquidity strains. A historical perspective. The 2008 financial crisis taught us valuable lessons. Many ordinary workers took bold action during the crash, buying assets at bargain prices. Those who seized that opportunity have since achieved financial security as markets recovered. However, after 2008, such opportunities became scarcer, with those who bought at the bottom now enjoying most of the benefits while others remain excluded. To avoid missing the next big chance, preparation is critical. Timing matters, but so does having the right mindset and strategies. Focus on learning proven investment philosophies rather than just asking, is it time to buy? And arm yourself with actionable knowledge. Take advantage of our free masterclass while it's still available. Opportunities like this are rare. We're still in the early stages of economic turmoil. The weakening US dollar may only be the beginning, with greater challenges likely in the next 90 days. This period is crucial for the US government, Fed, and global institutions to reach a consensus. Without decisive action, a more severe crisis than 2008 could unfold. If a global asset sell-off accelerates, recent stock market pain could worsen, making safe haven assets like gold, US treasuries, or certain currencies essential for investors. Preparation is key. The time to act is now. What does this mean? While personal milestones matter, the most critical date this year may be the last day of June, when $6.5 trillion in US government debt matures. Most of this debt was borrowed during the pandemic at ultra-low rates. But now the Treasury has only a few $100 billion in reserves, far less than needed to repay it. To cover the gap, the government must issue new debt to refinance the old. Since this debt was first issued, interest rates have climbed to around 4.5%. Imagine borrowing $1 million at 0% interest, spending it, and now needing to refinance at a much higher rate. That's more than $200,000 in interest over 5 years. The US faces this dilemma on a massive scale. Previously, investors eagerly snapped up US treasuries at low rates, viewing them as risk-free assets that tended to rise in value. Some used heavy leverage, buying $56 million in treasuries with just $1 million in cash. But since March 2020, bond prices have dropped, and major holders like China and Japan have been selling. As bond prices fall, leveraged investors face margin calls, forcing more sales and driving prices even lower. This creates a vicious cycle, whereby even risk-free assets suddenly seem risky. This situation is like owning an aging house. You can patch it for only so long before repairs become unmanageable, forcing you to rebuild from scratch. The US faces a similar dilemma. Continually refinancing and paying higher interest on its debt is just patching the cracks. Eventually, a major reset may be needed, which could spark global economic turmoil similar to 2008 before recovery can begin. What could trigger this? Tariffs could be the spark, intensifying economic pressures and destabilizing markets. The Federal Reserve may be the only solution, likely by expanding its balance sheet. Printing money, buying treasuries, and lending to the government at minimal or zero rates. But what motivates the Fed to do this? If demand for US debt collapses, the government could face default, sharply devaluing treasuries and triggering a global retreat from the US dollar. Since the dollar's value depends heavily on faith in US debt, eroding confidence could spark a worldwide sell-off of dollar-based assets, disrupting not just the US, but global financial systems that rely on the dollar as a reserve currency. Given these risks, Federal Reserve intervention seems almost inevitable. Preventing default is crucial to protecting both US debt and the dollar. One option is for the Fed to print money while keeping interest rates high. But this would strain the government, which must pay much higher interest, around 4.5%, compared to the near-zero rates of recent years. Small rate hikes mean massive additional costs on trillions in debt. If high rates persist, the effects will ripple through the economy. Households, businesses, and the government could face mounting financial pressure, leading to more bankruptcies, less spending, and a slowdown. In such turmoil, investors with cash could snap up distressed assets at discounted prices, fundamentally reshaping the economic landscape. While this approach helps manage risk in the short term, it doesn't solve the deeper structural problems. President Trump has urged for rate cuts and aggressive stimulus, but the Fed has so far resisted. There's concern the government might be forced into drastic action, potentially driving down the value of bonds, stocks, and the dollar, and forcing the Fed to print money and slash rates. No matter the strategy, the result could be the same: sharp drops in US asset values and a major redistribution of wealth. If another crisis hits, it could be one of the last big chances for regular people to change their financial futures. If they're ready and willing to act, even though rates haven't dropped yet, they could if a crash occurs. Currently, stocks, bonds, and the dollar are falling, while gold is rising, a classic pattern during uncertainty. As the dollar weakens, U.S. liabilities shrink in real terms. For example, if $6.5 trillion is due in June and the dollar drops 10%, the real debt effectively shrinks by the same rate. Step 2. Gold as a hedge. When major currencies fall, gold typically rises. The U.S. with over 8,000 tons in reserves benefits as its gold holdings gain value, providing a hedge against devaluation and instability. Step 3. Tariffs and Fed intervention. The government could also use tariffs and monetary policy together. Tariffs may trigger global deflation, and the Fed could then print large amounts of money to stabilize the U.S. economy. This liquidity could shift investments from gold back into U.S. assets, prompting a market recovery. The timing is key. $6.5 trillion in debt matures in June, and tariffs are suspended until July. If a market shock happens in June, it could set off a global crisis. The Fed might respond by printing money and slashing rates, letting cash-rich investors buy distressed U.S. assets at deep discounts. As recovery begins, global capital would flow into the U.S., lifting the dollar and American asset values, providing U.S. investors with opportunities to buy more discounted assets abroad and further strengthen their positions. Though this scenario may sound speculative, history supports its plausibility. Before both the 2008 financial crisis and the 2020 market turmoil, the dollar weakened, only to rebound following Federal Reserve intervention. Astute investors typically sold assets ahead of the crash, bought undervalued opportunities during the downturn, and benefited as markets recovered. This cycle, panic selling, strategic buying, and eventual recovery, has replayed throughout financial history. Take time to watch our full video series, as each episode builds on the last for a comprehensive view. In these volatile times, staying informed is more important than ever. My best wishes to all my viewers. May you achieve financial freedom. If even one insight here resonates or helps you take a step forward, then that's success for me. See you in the next video. Take care.